Welcome to the latest episode of our podcast series for financial advisors. Today's episode is The Seamless Path to Independence, a $1 billion RIA's evolution. It's a conversation with Tony Parr, founding partner of the Parr McKnight Wealth Management Group. I'm Jason Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more.
Most advisors associate independence with leaving the wirehouse world entirely, launching a firm, changing platforms, and building from scratch. But what if there's another way? A path that offers the freedom, flexibility, and control of independence without stepping outside of your firm's ecosystem. That's the story of the Parr McKnight Wealth Management Group, a $1 billion-plus team that built their business at Wells Fargo Private Client Group, where founding partner Tony Parr landed after a series of mergers, culminating with Wells Fargo taking over Wachovia. Growing the business over time, Tony leveraged Wells Fargo's independent channels to slide into independence and create their own entity, their own vision, and ultimately their own future. In this episode, Tony and I talk about how they structured what he described as a frictionless move that preserved continuity for clients while unlocking real autonomy for the business. He discusses why they chose first to slide into Wells Fargo's independent broker-dealer channel, Finet, and then ultimately chose to build their RIA with First Clearing and Trade PMR. Tony also describes the transition process and offers his perspective on building a multi-generational team and how that influences their thoughts about succession. And Tony also shares their COWS philosophies: clients, owners, workers, and society, and how that simple framework continues to shape the way they grow, serve, and lead. Whether you're exploring independence, thinking long-term about succession, or just looking to hear how a high-performing team turned optionality into real enterprise value, this is a story worth hearing. Let's get to it. Tony, thanks so much for joining me today. Thrilled to have you here.
Hey, Jason, thank you for having me. I'm so delighted to be here, and I'm super grateful to have a spot on your podcast. I've been a fan of your podcast for a long time. I moved out to farm country in Minnesota. I've got a little extra commute time, and Diamond has a treasured place in my podcast library. I remember the Dave Mullen podcast from May 15th about what it takes to be $1 million producer. I posted that on our team's account. So super thrilled to be here, and I already feel a debt of gratitude to you guys.
I love it. That might be one of the best intros we've ever had. You won't have to disclose how much money I paid you to say that. No, thank you. Truly, really appreciate the kind words. We do this as a labor of love because we believe in all the things you're talking about and exactly the types of questions I'm going to ask you. The purpose of this podcast, I often remind myself, right? Why did we do this podcast? And the purpose is to educate advisors and to arm them with objective information and tales from people who have walked the path before. So to that end, tell us a little bit about your background and specifically maybe how you got started in wealth management.
Yeah, tales from 38 years in wealth management. Now, maybe I'll approach it both personally and professionally in terms of background. I'm born of a Swedish mother and a Cuban father, and I've lived in San Juan, Puerto Rico, Mexico City, and Minneapolis since I was 10 years old, 1976, with a brief stint at Boston University. My mom emigrated here from Sweden at 18 years old. And I remember sitting around the breakfast table on Sundays, and she'd pull out the newspaper, and she was clipping coupons so she could live within the budget that my dad gave her every month. It was a patriarchal household, but I remember just admiring my mom for doing that. We lived in a nice house, and she was still clipping coupons looking for the best value. And I feel like that kind of translated into this career. Now, my dad, he was born in Havana, Cuba, and my family on that side was actually involved in the Cuban dictatorship before they became a communist society. My grandfather was involved in the military. So when Castro came down from the mountains in January of 1959, my dad had to leave everything behind. And that was a 300-piece gun collection, a country club membership, a boat, couple sets of golf clubs, a nice house in Havana, a 1,000-acre farm in the country. And he showed up in Florida with nothing. So just to have it all and then lose it all, I feel like that translated to this business too, because we've got this philosophy of preserve and protect and conservatively grow our clients' assets. I never want a client to have to experience the thrill of building a pile of wealth and then the discouragement of having a major setback like that. So that's a little bit of the personal background. Professionally, I'd have to go in the Wayback Machine to 8th grade. I was one of 2 kids selected to have an internship at Smith Barney, an old firm that was eventually merged into Morgan Stanley. And what I noticed there, Jason, was that the guys wore nice suits. They drove nice cars. It was warm in the winter, cool in the summer. There was no heavy lifting. They didn't get any dirt underneath their fingernails, and they seemed to get paid for talking on the phone all day. So that was 8th grade, and that planted a seed. My later exposure came after my mom was diagnosed with MS. I had this crazy summer job working at a grocery store warehouse on the graveyard shift. And I had a quota. It was a grind. I did 3 summers there, but it was interesting. I learned a lot there. I learned about resilience. It was like I slept all day. I got up, I putzed around for a couple hours. Then I showed up at the warehouse at 9 p.m. and I had a quota. I had 1,200 boxes to throw. I learned resilience. I learned that I had to pull an all-nighter every night. I learned about planning and detail. You had to plan your order. You couldn't put the toilet paper on the bottom and the jugs of vinegar on the top. You'd have a spill in aisle 4. So it just relates to being detail-oriented with clients and having the right structure to the portfolio and the plan and the relationship. And that detail often involved grocery store orders of 200 items. And you had to get it right. Otherwise, you heard about it the next day. So after 3 summers of doing that, I decided that mom was ill. I didn't want to work all night, sleep all day. So I walked down Main Street in Wayzata, which is a tony suburb of Minneapolis. I landed an internship at a regional firm called Piper Jaffray. It was a premier regional firm. And I worked in the mailroom. I matched up trade orders with confirmations. Jason, I basically did anything that other people didn't want to do. And when I graduated from college, I went back to my friends at Piper and I got enrolled in the account executive training program. Now, account executive sounded like a glorified name, but I basically became a stockbroker, calling people on the phone with the hot idea of the day. You always had a growth idea, a tax saving idea, or a high income idea. And I became part of 2 different, slightly dysfunctional teams before venturing out on my own. And then the quality of life went down. I had success in the business, but my quality of life went down. And I learned leverage by hiring interns. And fast forward to today, I believe half of our 15-person team are former interns of mine. So, Jason, that's a little bit about the background that led me to wealth management, both personal and professional.
Super interesting. And I love how you tie the personal experience, like how it shaped basically who you are and how it led you to be the advisor and the person you are today. Can you also now provide a little bit of context on the business? So Parr McKnight, and give me a little bit the services you provide, who you serve, and some size context as well.
Yeah, absolutely. Parr McKnight Wealth Management Group. We're based right in downtown Minneapolis. We are a 15-person ensemble team. And I think it's important, a lot of your listeners probably know ensemble versus silo, but ensemble means we all work together. We all sing from the same hymnal. We all have the same philosophies and strategies and processes. We collaborate together versus a silo approach where you might look at a team picture of a 15-person team, but it's actually 6 different advisors with their own support people and their own clients. And there's not a whole lot of cross-pollination, if you will. So we are a multi-generational firm. We're planning first, which is evidenced by the 7 certified financial planners on our team. Once we outgrew the glorified work group label and actually felt like a real business, we needed some structure and scaffolding around the business and decided to hire a coach. So, a lot of your listeners have probably heard of the book Traction by Gino Wickman and the entrepreneurial operating system that book espouses. We've wrapped that around our business and just feel super good about the structure we put in place. So, we're highly structured in the way we run our business and work with clients, but we've got what I'd call a pretty casual work environment. It's okay to show up in jeans, which is great camaraderie, great collaboration. We've got a great culture. In terms of size context, we've just barely crossed $1 billion in assets under management, which is the common metric in this business. I like to refer to that as 1 billion units of trust because they all represent trust from clients. We've got about 400 clients, 300 of which are affluent families. And our target market, if you will, those families that we work the best with, really come in 3 stripes. Number 1 are what I call second half planners. And most advisors call these retirees. But I have to tell you, Jason, I really enjoy working with people that really want to have a purpose-filled second half of life. Your average 60-year-old, they might think they're old, but if they live till 90, they've got 50% of their life left. And it's much more interesting working with somebody that's really looking forward to having a purpose-driven existence after retirement than that person that might just retire, play golf 5 days a week, go to the all-you-can-eat buffet, play some cribbage, and get up the next day and do it all over again. I think that's actually a recipe for disaster. So we want to work with people that are really excited about the second half and want to work with us on helping to plan and envision that. The second group of clients that we work well with are business owners. We own a business. We've got a business coach. We've grown our business over time. We think we operate pretty effectively. So again, there's lots of good cross-pollination ideas that we can share with business owners. I know we'll talk a little bit about succession planning, but that's another thing that's first and foremost on business owners' minds. So we work well with them. The third niche, if you will, that we work with are corporate executives. And these tend to be driven human beings. They're tremendously busy with work. They've got complex compensation plans that have to do with RSUs, options, mirror pension plans. So we help them maximize the benefits that they're getting from their corporation and manage their affairs they prefer to delegate and collaborate with us, but they like things pretty clean, pretty straight, and they want to save on time. So they delegate a lot of that to us. So really the second half planners, the business owners, and the corporate executives are our target market. And Jason, I might also add that we really try to deliver excellence to these clients by using what I call, funny enough, the diamond approach to client service. And that means the client sits at the top of a diamond. It's a very strong structure. On one side, you have your primary financial advisor. On the other side of the diamond, you've got your paraplanner. And supporting that entire structure is the most important person in the room, is the primary service person that handles the day-to-day needs of the client. We gravitated towards that structure. It's resulted in what I believe to be exceptional client service. And it really frees up the primary advisor to do what they do best while fostering and growing the paraplanner to become a primary advisor at some point in the near future. So our work family, the CFPs, we've got about 200 years of cumulative experience. I'm really proud to say we have 0 regulatory dings, not even a complaint letter in 200 years of cumulative experience. And really that clean record reflects our do the right thing attitude. So Jason, that's a little bit about Parr McKnight and how we're structured and who we serve.
Wow, you named your service approach after us. No, I'm kidding. I understand it's named after the sheep.
Very intentional.
A couple of things there that you said that resonate with me. First of all, you talk about culture and how for you guys, culture means the camaraderie, the family feel, and you wear jeans to work. And it strikes me because I've worked with teams in the past who have encountered either people they're interviewing or firms they're considering doing business with, and they've seen people in jeans and been turned off because their culture was buttoned up suit and tie. And it reminds me that there's no blanket answer to culture, right? It's what works for you, and it's what works for probably more so your clients. I think it sounds like you speak the language that your clients speak. So I love that. And then the other thing, you say 1 billion units of trust when you think about your assets under management. First of all, I agree that for whatever reason, $1 billion in assets under management seems to be a little bit of a magic number in our industry. Well, I think in part that's because at $1 billion, the world is your oyster. You have really unlimited optionality at that point in terms of, do you sell your business? Do you transact? Do you partner? Right? It really does unlock a lot of doors. But I love how you frame it through the lens of, I think we get jaded by big numbers, and these are clients and these are people's lives. And when you have $1 billion, like, stop and reflect. That's $1 billion in assets that you're managing on behalf of real everyday people. So thank you for sharing that with us. I want to now move on to what I call your career journey. And your career journey was somewhat common in the sense that you moved from more captive channels to more independent channels over time. Ultimately, now you have the most autonomous form of business ownership there is in your own RIA. But I think what's interesting for you is you've always kept at least some affiliation with Wells Fargo. So there's a lot to unpack there, but can you just briefly walk us through what I call your career journey?
Yeah, well, I got hired at this regional where I was a stockbroker. I got to just say it that way. We left Piper Jaffray and Hopwood to go to Prudential Securities, and that was 1993. And it seemed like that was near the beginning of this move to getting paid for advice versus transactions. Prudential Securities merged with Wachovia. A.G. Edwards was folded in. And then Wachovia became one of the casualties of the 2008 crisis. And I remember, Jason, falling to my knees and shedding a tear. Wachovia had fallen from roughly $50 a share to 50 cents a share. And then Wells Fargo came in, and they were the white knight in the industry at that point. They came in and took over Wachovia, and we became part of the Wells Fargo private client group. And I worked in a big building in downtown Minneapolis. I was a big branch manager, I don't know, probably 50 or 75 advisors down there. And Wells Fargo, bless their hearts, they've got just a wonderful channel-to-channel operation where you can move and achieve greater independence as you establish your business and as you nurture your entrepreneurial spirit. So within the branch, we were allowed or approved to go to something called profit formula. And that's basically where you stay in the branch, but you absorb your pro rata share of the branch expenses, your support team, the square footage, even a proportional share of the square footage in the lobby, the bathroom, and the hallway. But it gave us a little bit of experience managing a P&L and being responsible for more of our capital allocation decisions. So after we did profit formula, then we were allowed to navigate to FINET, which is the supported independence channel of Wells Fargo. And I remember walking out the door on a Friday afternoon and showing up. We're about 4 blocks away in our new building, Parr McKnight Wealth Management Group. We had a stacked stone wall. We had our own signage, and I got emotional. And I just thought for that moment, this is ours. Now, it's not entirely independence. I said supported independence. And the two things that we still worked with Wells Fargo on, they still were our compliance overlords, and we were still beholden to their technology stack. So it was good. I mean, we kept growing the business. We kept delighting clients to the best of our ability. But then as our multi-generational team was taking shape and the younger people started having more of a voice, we became aware that there was a lot more to this fintech revolution. And how could we remove the friction from our business by employing the latest technology? How could we maybe liberate ourselves from these corporate compliance departments that, Jason, they're hamstrung to a certain extent because they have to cater to the lowest common denominator of advisor. And I can tell you, 200 years, no compliance dings, not a complaint letter. They still paint everybody with the same paranoid brushstroke, and they live in an atmosphere where they live in fear of being sued. And we're a little creative, we're a little edgy, we push the envelope in an ethical way, and we just got rubbed the wrong way. I mean, just to give you an example, I wanted to put out an email to clients that just advertise short-term treasury bill rates, which were then in excess of 4%, they still are, versus the bank deposit sweep, which was paying a rounding error from 0. It took me 90 days to get approval. It just became frustrating, and because of the energy and enthusiasm of the young people on the team, I think we accelerated our move to independence. And just kudos to Wells Fargo. Every Monday afternoon, after we announced that we wanted to become a registered investment advisor and made our commitment, to stay within the Wells Fargo ecosystem, at least for custody of the assets. Every Monday afternoon, we had a Zoom call, and it was the new entity, First Clearing and Trade PMR, and the old entity, Wells Fargo, working together to remove obstacles, to help us with problems, to help sort through the issues. It was just an easy, low friction way to become fully independent. And first and foremost, throughout all of those processes, we thought of our clients, right? If you sneak out the door on a Friday afternoon and you go from the private client group to go set up your own RIA, you had to sneak around in the middle of the night and get your site set up, buy your technology, put in your systems. Your firm couldn't know about that. And then you sneak out and your accounts are distributed to everybody, all your former friends. And then you've got to call clients and say, hey, I made a change. Expect a blizzard of paperwork, and you have to repaper everything from custodial accounts to 529 accounts to retirement accounts, trust accounts. It was a nightmare. When we moved, we had clients that had to sign 2 pieces of paper, and we did it DocuSign. It was an investment manage agreement and a consent form to change custodians within Wells Fargo. So it was little by little. There was no big bang, no big disruption. And I just feel everything happened in its due time. So glory to my team who helped with all this. Everybody wore multiple hats. But Jason, that's a little bit about the journey from stockbroker to fully independent.
That is an incredible story, and there's so much to unpack there. And it sounds like I think a lot of people feel this pressure to nail it the first time. A lot of times that plays out in, do I move from, say, a wirehouse model to a regional firm or to an independent broker-dealer, even if ultimately it's going to be an interim step to eventually being in the RIA space. And for you, I think what you're saying is everything happened in due time exactly as it was supposed to. Right now, you are exactly where you're supposed to be. But in part, that's because you had those previous chapters. Your credit to Wells Fargo, I have the same thought as you. First of all, this channel affiliation choice is a big deal. The fact that a firm allows advisors to genuinely choose and move freely among their various affiliation channels, meaning in the case of Wells Fargo, a W-2 channel, they also have a bank channel, an independent broker-dealer in Finet, and then ultimately this RIA custody channel. To allow that, and to your point, to make it frictionless and to even, it sounds like, encourage that, is a breath of fresh air, because we get the question all the time from advisors who like that idea on paper. And they wonder, is it really that easy in practice to say, I can move from a W-2 channel into an independent channel? So it is refreshing to hear that in your case, that was a home run.
I thought maybe when we announced that we wanted to leave, they'd brand us with a scarlet letter and treat us like the redheaded stepchild. But our branch manager, Chris Murphy, was honestly just really interested in what was best for us and best for our compliance. And actually, Jason, I think they were a little tired of me because I was an agitator for advancing their technology along the way. And I love the people there, and they're hindered by a little bit of their bureaucracy. But it was always, well, that's a great idea. We're looking at it, or we're thinking about it. And that's corporate speak for we're really not doing much. And you have to have some empathy for these big firms, because what they're doing is they're taking these enormous legacy technology systems and then really trying to lay new systems on top of that. So it becomes like this patchwork that just didn't really work as well for us. So we feel great. We removed the friction and just really elevated the client experience. Again, kudos to Wells Fargo for allowing that. It blew me away that they would volunteer every step along the way to compress their profit margins. And now we pay for custody. We get great service from Trade PMR, and we're just in a really good spot. So
yeah, I guess the thinking is it's better than the alternative. If the alternative is your assets would ultimately move to, say, Schwab or Fidelity, right? If your team is set on launching an RIA, then one way to look at it for Wells is these guys are going to launch an RIA. We'd rather them do that quasi-internally than do that with Schwab. The other thing I want to ask, though, is to play devil's advocate. I agree with you. The benefit of the internal slide is it protects the flank. It's relatively frictionless. It is definitely the easiest way to move into more independent models. But the downside is typically it doesn't really allow you to take a transition deal, because when you move the business externally, firms are willing to pay, as we know, 300, 400%, or even 100% in the independent space. So how did you reconcile never really monetizing the book, right? You knew you could have gotten these big transition checks and you chose not to take them.
That's a great question. I like the way you put it, monetize the book. When I was 5 years into the business, I had very few clients, very little revenue. So the transition check wasn't very big. And I took my family to Disney World. I bought a couple of early stage medical tech device stocks that didn't work out. And then when it came time to repay the loan, pay the interest and taxes, it was painful. And even if advisors do smart things with the money, I think over time you end up with around 50 cents on the dollar between the interest you pay on the note and the taxes that you have to pay as that becomes ordinary income to you and the note is forgiven. Honestly, Jason, I was always a little bit resentful, I guess, is maybe too strong a word, but I was resentful that firms paid these because that goes back to the capital allocation decision. We want an easier compliance department to work with. We want better technology to elevate our client experience. And you just paid the Merrill guy 400% at T12 to come over. We could have spent that money a little bit better. And it seemed oftentimes like firms were treating their adopted children better than their real children. So taking a deal, I think it just goes back to there's no such thing as easy money. And we didn't want to be beholden to a new master for 10 years. We wanted to be masters of our own universe. And when I think, Jason, about the value that's been built in this business for myself, my partners, and the compensation and benefits that we pay our team, it's the equivalent of 20 transition packages. Just the value that we've built, navigating through those channels, doing the right thing for clients, and treating your people right. We got tremendous value from that.
Yeah. Plus, I think the equity value you've created along the way, completely agree with that school of thought. I will say, in fairness to these firms paying transition deals, I've heard the argument before of along the lines of what you're saying, which is the firm is saying, crying poor on the one hand, like we don't have the resources to reinvest in the platform, or we're cost cutting, or there's margin pressure. But on the other hand, they're writing massive recruiting packages. But in defense of these firms, and I guess in fairness, take this with a grain of salt coming from a recruiter, I think firms need to recruit. I mean, we've seen firms, notably Merrill, right? Probably the most recent example of this, where they stop recruiting competitively. And the impact on morale and the impact on existing advisors can't be overstated. And it oftentimes leads them to turn the spigot back on into competitive recruiting. So just a quick aside there.
Hear you and I agree. I mean, you can recruit a great advisor, bring him into your office, and it lights up the whole environment and raises the bar for everybody. So absolutely, you need to recruit for your team. Professional sports teams do it. Firms should do it. It just wasn't right for us.
Totally fair. I respect that point of view immensely, and I thank you for sharing it with us. I want to ask, though, specifics, because I think people talk about independence sometimes in almost like a nebulous or like a hazy way, where they're like, well, you can do so much more. You're so much more free. But what are you actually more free to do in your day-to-day? So give me some things that you can do now that you couldn't do in your previous channels of affiliation.
Yeah, I would. Maybe I'll answer that in 3 different categories. Let's talk about technology. Let's talk about client communications, and let's talk about operations and compliance, maybe in one blob. When you go independent, you get 100% payout, or at least that's the payout we're on right now. Now, we are not making any more margin or putting any additional dollars in our pocket. We unleashed a budget of about $300,000 on new technology to operate the firm and to elevate our client experience. So I don't know if you mentioned specific names on the pod, but we installed Orion, which will eventually allow us to go multi-custodial. And we'll pick up another partner like a Fidelity or a Schwab. It's just the beast of a software package that can do incredible things. And we're just scratching the surface, and we're in amazement at what that can do for our business and reporting to clients. Another aspect of Orion is the reporting results to clients. The performance reports are customizable. It's incredible what we can show clients. Trading, discretionary trading for client portfolios is a breeze using Orion. And one of the things that used to drive clients nuts is if they had, let's say, a $4 million rollover, and we wanted to have a strategy that invests in small and mid caps and maybe a rising dividend strategy. and then maybe a laddered fixed income strategy, and maybe an aggressive strategy. We'd have to open up 5 different accounts for that one rollover in the same registration. In other words, it's an IRA, but we had to open up 5 IRAs. Orion allows us to sleeve those portfolios, have one account, and it's just more simple that way. I guess the better example is in like a revocable trust where you'd only have one tax reporting document for that account. But if they go to their Orion portal, they can see how each of those strategies is performing separately. So Orion's been amazing. We're a true contact management system, Wealth Box. We can customize workflows to deliver greatness to our clients and to remove the friction internally. It's got incredible reports that put out our KPIs with the push of a button. And so many times these contact management systems at these big firms, they're not contact management systems, they're surveillance systems. So we finally feel like we've got a true contact management system. Right now, we're working with Jump AI. We're just doing a pilot. We're going to pick it up. It's an amazing artificial intelligence inspired note taker that creates a summary of the meeting, a follow-up email, and automatically feeds the tasking into our contact management system. Tremendous time saver. One more on the technology front, FP Alpha. We're using AI now to scan clients' tax returns, their estate planning documents, and their insurance documents to get a distilled view of what's going on in those documents, advise the clients on strategies, and make it simple. So just a tremendous time saver there. So Jason, that's a little bit of the technology. Client communications and compliance is another one. When we were in the captive environment, we had one website provider for the entire firm. Now we can do our own website. Updates take overnight, so not 6 months. And we've got somebody on the team that's a marvel at doing that. So we've got a great website, a robust pattern of updating that website, because the only thing worse than no website is a stale website. It was too clunky in the captive area. It's a breeze now. Social media, our social media presence has expanded exponentially now that it's gotten easier. We've got a YouTube station. I just did a webinar for clients about 2 hours ago, and within a day or two, that's going to be up on our YouTube station. We did a webinar on crypto. It had, between attendance and views on YouTube, 200 people. So we're getting that exposure and leverage that we couldn't get being captives. Levitate, we're using Levitate for client engagement to manage our campaigns. It's got suggested communications for clients. You can run the communications through AI to give it your own flavor. Texting is easier. Zoom webinar we didn't have. So just incredible additional ways to communicate and light clients up. And in the operations area and compliance, for my webinar today, it went to our compliance person. We have a private compliance attorney. It went to them yesterday, and we had it back same day. It was like a 3-hour turnaround. They know us. They know our record. They know we're not trying to pull a fast one on anybody. So it's not catering to the lowest common denominator. It's catering to us. And they know us, and they approve stuff a lot quicker. So that's a good thing. Staffing, we can hire and fire, and there's no mandates, and there's no quotas. And I remember you need $1 million in production to have your own support person. No, you don't. We get to decide. The other thing that I love about being independent is we can put together our own benefits program. And we matched pretty much everything Wells Fargo had to offer, but then we offered a subsidy for pet insurance. We match charitable donations. We provide $500 towards a travel ticket, airfare. We just do a lot of things. Everybody has their own office. Everybody has heated parking, which year after year is the #1 benefit here in Minneapolis. We like to take our polls in the middle of January, but we've got heated parking. Those things are unheard of in the wirehouse.
Advisors in Florida right now are like, what is this guy talking about? Heated parking. That's a phenomenal answer. Honestly, that was an extensive list, probably the most detailed step-by-step list I've heard, at least off the cuff like that. In a nutshell, what independence is all about. I think you laid out I mean, not everybody's going to say those exact same things, but that's the ethos or the spirit of what it's all about. I'm curious, when you do something like this, do you tell your clients each step along the way? Because ostensibly the assets are staying in a similar place. Like, how much client explanation is involved? How much paperwork is involved? What is that process like? And what was the reception like on the part of your clients?
Yeah, well, just the bottom line KPI on that one is 99.99% of our clients came with us. There was one that was left behind and they were just unresponsive because they'd been relatively unresponsive for the last 5 or 10 years. So it's not, Jason, what you would call regretted attrition, but the communication was very thoughtful and consistent and deliberate. And if I were to summarize, it's we were tuned into WIFM radio, which is what's in it for me from the client's perspective. So, Mr. Client, we're going independent. We're going to have all kinds of new technology, and we're doing that so that we may elevate your experience in the following ways. And people were just excited. Not to rag on Wells Fargo, but they were like the poster kid for bad news for a long time. And Jason, that was tough because we do the right thing. And if Wells Fargo steps in it, we were tarred with the same brush. And they had some criticism heaped on them, some fairly, a lot unfairly. They became the poster kids for beating up on financial institutions. So I felt some empathy and sympathy, but we were tarred with the same brush. And I had one client in particular that several years ago said, when you end up somewhere else, I will put a bottle of champagne on your doorstep. So if you do things for the right reason, right? You don't want to do what you do just for the money. If you do it to enhance the client experience and to remove friction for your team and explain that thoughtfully and clearly with benefit statements for your clients, they'll come along. They'll come along gladly. And they all did.
What about logistically? Like, was this a repaper at any step of the way? Because I think we get that question from our audience sometimes. I know we get that question sometimes about, is it really as easy as we're led to believe it is?
Yeah, well, for us, I'm not going to say it was easy because there was a lot of thoughtful communications going on. There were some slip ups with DocuSign. We can do this, we can't do that. There were some changes midstream, so we had to adapt and overcome to some issues, but you always have to do that. But when you have a DocuSign that asks the client to sign an investment management agreement, and you have a DocuSign that says, we would just like to lift up your investment shoes from a shoebox called Wells Fargo and put them in a shoebox called First Clearing, and it is still in the Wells Fargo house, there really is not a lot of resistance to that. So we made it as easy as possible. And again, kudos to the team for just delivering a white glove experience to clients. So what does white glove mean? That means if you've got an elderly client down in Naples and they don't know how to do this, you send somebody down there on an airplane to go to a bank branch with them to flip bill pay from one account to another, or to help them open up an account and move their bill pay over. If we had tax checks being issued or Social Security checks being deposited, that was part of the benefit of navigating within the Wells Fargo ecosystem. They were able to generate all these reports for us that identified these little roadblocks or little bumps in the road where clients might have a difficult time, and we were able to proactively address those rather than have that be a nasty surprise down the road. So it wasn't easy, but it wasn't as hard as, hey, your household has 22 accounts with us. Here's a ream of paper, sign it and get it back as quickly as possible, while your former friends are calling on that account saying, hey, they're gone, keep your account here. That was just something that I'm so glad we didn't have to face. So the messaging was good. The team just stood up and did the right thing for clients. I'm just looking at my desk right now. We've got these red buttons on our desk that say easy on top of it. And it's the Staples easy button. That's part of our DNA, is how do we remove roadblocks? And everybody had to be on the alert. And Wells Fargo and Trade PMR were super helpful in helping us front run those for clients.
I think that's a healthy perspective for advisors to keep in mind, that, to use your words, it certainly wasn't easy, because that is one of my pet peeves in advisor recruiting, is when firms tell advisors effectively it's a light switch, right? The light switch one day is flipped to W-2 mode. You flip the switch and you're in 1099 mode. And I'm always quick to educate it, like, no, that is not the case. Yes, you can do it. Yes, it is a beautiful benefit. It is absolutely a reason to consider one firm over another, but it's not a light switch. And it sounds like that's exactly what you're saying.
Jason, pain and problems, they're always going to be around, but removing the friction and being able to be accountable for our own stuff rather than running it up the flagpole and it goes to legal and it goes to compliance and the branch manager. And it's just like, no, the buck stops here. We're fully responsible, fully accountable. And I think we did a good job with that freedom and that flexibility and that control we had over the process.
That's an excellent point, actually. The idea that even if it was the exact same set of problems, and I'm not saying it was, but even if it was the same set of problems, you're in charge. And that is a common pain point among advisors, is not so much that the answer is no or that it's restrictive, but captive advisors often complain about the idea that they just don't have any agency over their professional lives. Like they're at the mercy or the whim of the firm. And I think what you're saying is even when stuff goes wrong, it's a nice benefit to have, more than a benefit. It's a integral part of your business model now to have the ability to be the decision makers. The buck stops with you.
You got an issue, it's all Parr McKnight troops to the front line. Here we go.
Yeah.
Bring it on.
Did you consider external options, or was this always just too compelling of an option?
We did. We got pretty close to the finish line working with Schwab, and they are great people over there. And we just thought the slide was too easy for clients, right? It wouldn't be this massive upheaval. And with the technology that we put in place, now we can methodically go about becoming a multi-custodial firm and maybe bringing on a partner like Schwab or like Fidelity. But that doesn't mean there aren't other options. We got introduced to Sanctuary, to Dynasty, to Rockefeller. Some firms are private equity backed. Others took a portion of your practice and a lower payout. Some had the pre-designed tech stack, the internal compliance. We just wanted to do our own thing. And like I said before, be masters of our own universe. We've grown nicely over time without taking on outside capital. So we did consider a lot of options. We were in due diligence mode for a long time, had fancy spreadsheets that identified the pros and cons of each firm, but we just kept coming back to what's best for clients right now, and then what's best for our firm and our employees, and then what's best for us as owners of the firm. So all roads pointed to the path of least resistance that created many options in the future.
That's excellent. And I love that it starts with clients as exactly as it should, because I think a lot of times that's the one thing we remind advisors more than anything is that without your clients, none of this works. So the story has to resonate. I want to talk a little bit about, and I'll give you maybe two more questions because I know we're brushing up on time here, but your team seemingly is set up intentionally at many different generations where you have advisors at different stages of their careers. Do you view that as a part of your strategy? Was that an accident?
I'd love to say it was intentional. Maybe it was subliminally, but I get out of bed in the morning, my feet touch the ground. I'd say I can't wait to get to work. I love the people that I work with. And here's the way it lines up. About 30 years ago, I had an intern named Brian McKnight, and he became so valuable to the practice that we brought him on full time. That's when I was with Prudential. Brian is still with us. He owns a large part of the firm. He's a former intern 30 years ago. John Rudy was an intern about 20 years ago. Again, same story, became valuable to the practice. He is now a partner and owner with the firm. Another owner of the firm is Nelson Moen. He's my stepson. He's got a small percentage in the firm. He was an intern 8 years ago. We've got two paraplanners, Joe and Emily, who are now full-blown CFPs and received their first clients. They were interns 3 and 4 years ago, and now our financial advisors. So we've got a homegrown team, and it's just a wonderful generational approach to working with families. We've got advisors in their 20s, their 30s, their 40s, their 50s. I'm knocking on the door of 60. And Jason, every Thursday morning, we have an advisor meeting. All the CFPs get on the phone for an hour and a half, and it's magic. We talk for an hour and a half. We look at the calendar in the last week. What meetings did we have? What meetings do we have coming up? What client issues have come up? And then we hear from the 20-year-olds, the 30-year-olds, the 40. It's just this multi-generational wisdom and perspective that comes together. So when clients come to Parr McKnight, they're not working with one advisor. They're working with 7 that all have different perspectives on the world. And I am never lacking for an answer to what happens if you get hit by a bus, because half the team could get hit by a bus and we are still an enduring firm. And it makes for a beautiful succession plan where we don't have to take on outside capital. We can do a series of small internal transactions so we can distribute equity. And more importantly, that equity mentality, that ownership mentality, we can distribute that to others on the team through outright sales financed by a bank. We're currently going through an engagement with a company called FP Transitions to ascertain owner compensation, to validate our compensation stack, and to look at equity participation models like, are they an income partner? Are they an equity partner? Do they get phantom stock? Are we going to put in a 409A plan? Can we wrap a long-term incentive plan as a bonus structure around somebody's base pay? So we got a great multi-generational team. And one of our slogans is, allow our family to serve yours. And it's so exciting to come to work every day with that type of a structure and those type of people that all share a common philosophy.
But your passion for it and your authenticity shines through even just in answering these. I love to hear it. By the way, what you were talking about, intentional or not, that was why I asked the question, because this idea that every team, every firm, every advisor needs to be thinking about succession, and you've built in a mechanism by which the book should pass really nicely from one generation to the next. Kudos to you, because a lot of firms, I think, again, whether it was intentional or otherwise, a lot of firms are envious of that position.
We're going to keep working at it until we get it right.
Absolutely. My last question for you, and please, I hope you'll give me an answer, not just growing in assets, but what does Parr McKnight look like in, let's say, 5 years? Like the next chapter, obviously everybody wants growth. It'd be great to get to 2 billion, 5 billion, 10 billion. But beyond that, tell me what excites you.
Well, a little backstory to this. I mentioned that we run our business with traction with the EOS system. And part of that system is coming up with a 10-year vision for starters. Number two, then you want to figure out where you're at in 3 to 5 years if you're on track for that 10-year vision. And once you have that 3 to 5 year picture, then and only then do you back it into a 1-year plan. And from that 1-year plan, you look at rocks or quarterly projects that each person on the team is empowered to do and held accountable to do that propel the firm towards that 10-year vision. And as we were working with our coach on our 10-year vision, he said, "What's your number?" And I didn't want to cough up a number because I was asking myself, why are we here? Are we here to hoover in client assets to come up with a big number? If we propose a big number to our team, we've got $1 billion, maybe we want to be a $5 billion team in 10 years. How is that motivational to the employees? Sure, it's really exciting to be part of a growing enterprise, but $5 billion, oh, well, do the owners get to buy their private airplane, their third home, take more expensive vacations? That's not motivating. So we ended up hanging a number on it. And the whole conversation to me was inspired by a book that I read called Small Giants. And it was really about companies. It was a number of case studies about companies that intentionally chose to stay small, to stay close to their clients, close to their employees, and close to the communities that they work in. And that was inspiring to me. So we hung a number on it. We'd love to be a $5 billion firm because that means that we're doing a great job for clients. And I like the words of King Solomon when he asked God to make him the richest, most powerful, most wise person in the universe. He said, "So that I may take care of my people and the widows and the poor." He wanted it for good. So we want to be a $5 billion firm so that we can take care of cows. And that's an acronym. The C stands for clients. We want to give clients a magical, anticipatory experience that propels them along the path towards financial freedom. C is for clients. O is for owners. We have capital at risk. We put sweat equity into this business. We merit a reasonable profit for our efforts. As workers, we need to have a work environment that allows people to perform in their magical ability, do the right thing for clients, have a balanced lifestyle, not feel like they got to check email when they're on the vacation. And the owners are owner operators. We are workers also. So we need a great environment for our workers. And the S in cows is society. You need to benefit the community that you're in. You need to give back from the blessings that you've been given. So it's a long answer to, we want to be a $5 billion team so that we can take care of cows, the clients, the owners, the workers, and society.
I absolutely love it. It's a really thoughtful answer that, once again, just another topic where I think your passion and enthusiasm shines through. I could continue this conversation all day. Truly been a wealth of information, and I so appreciate you being on. I am excited to revisit this in 3, 5, and 10 years so we can hear more about the story and the growth and how you're doing with the cows. But Tony, for now, thank you again for coming on the show.
Yeah, and thank you, Jason, and thanks for all your help on our journey to independence. Love Diamond and appreciate being with you today.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.